viewers, welcome to today's class, P/E ratio. Everyone talks about it, but what does it actually mean? You see a low PE and it feels like you found a deal, like you spotted something everyone else missed. That feeling is exactly where the mistake happens.
But a low PE could also mean earnings are falling, the industry is shrinking, or the company's best years are behind it.
PE ratio alone does not tell you if a stock is a good buy. It tells you something very specific, and it needs context to make sense. PE stands for price to earnings. You calculate it by dividing the stock price by the company's earnings per share. Let me make this real. NVIDIA's PE has ranged from around 35 to over 50, depending on when you check. What does that actually mean? It means investors are paying $40 for every $1 NVIDIA earns in profit. That sounds like a lot, but it is really a measure of expectations.
How much confidence the market has in this company's ability to grow its earnings in the future. A high PE often means investors expect strong future growth. A low PE might mean they do not.
Now let me show you why comparing PE across different industries is misleading. Now here is where most beginners get tripped up. At any given time, NVIDIA's PE might be 2, 3, or even 4 times higher than a bank like JPMorgan. Your instinct says JPMorgan is the better deal. But banks and tech companies grow at completely different speeds. Tech companies are expected to grow earnings rapidly. Banks grow steadily but slowly. So a lower PE is normal for a bank, and a higher PSV is normal for fast-growing tech. Comparing them directly is meaningless because the industries are fundamentally different. Context matters more than the number. 3 things to remember about PE. First, PE does not tell you what to buy. It only tells you what the market expects. It is most useful when you compare 2 companies in the same industry. NVIDIA against AMD makes sense. NVIDIA against JPMorgan does not.
Second, a low PE does not automatically mean undervalued. It might mean the business is struggling, growing slowly, or facing serious challenges. Sometimes a stock is cheap for a good reason. Third, always ask what the PE is telling you about expectations. A high PE means the market expects big things. A low PE means it does not. Neither is automatically good or bad. The only question that matters is whether those expectations match reality. This is the difference between reacting to numbers and actually understanding what they mean. One more thing, PE only works when a company has meaningful, positive earnings. If a company is losing money or has a one-time spike in earnings, the P/E ratio can be misleading. Always check whether the earnings are real and sustainable.
Comment below with another metric you want explained. And if you want to see how PE looks on an actual company, you can check it on StockSava.com.